lo que está pasando con el euro. Thank you, both of you, for being with us. So first of all, Marc, I would like to talk about the euro, and I would like to know if the measures taken by the European Union right now are the right measures, and how is this affecting the euro?
Sure, I'm not sure that these are the right measures, but in some ways it doesn't really matter. These are the measures that the European Union and the ECB are pursuing, like buying sovereign bonds in the secondary market, this stability facility to guarantee bonds. In general, I think that the European officials are not unhappy with the falling euro as long as it is gradual and not in an orderly fashion. We think the euro is still going to be falling, even if we get these momentary short-term corrections. We think the euro is probably going to go down another nickel or so from here to say maybe $1.15 this year, and then maybe down to parity next year. But as long as it's gradual, we don't think that there's going to be intervention, and we think this is generally a favorable development for European companies, especially those in the periphery of Europe that need to export more.
And what does the floor think about this euro going so low and the dollar strengthening? How is this affecting equities?
Well, I think short term, what you're seeing is a fall in the equity market in the broad indexes is that there's a lack of faith in the containment of the issue, at least short term. Long term, at least through the end of this year, that the multinationals that are based here in the United States are going to have trouble exporting to the European Union countries and their members because of the weakness in the euro versus the dollar. However, it should benefit some of the European companies, certainly the ADRs that trade here, that can export goods that might have been perceived to have been priced a lot higher or unaffordable to the American consumer or companies that purchase such goods.
So let's talk a little bit about that commerce situation, because now it seems that China and Southeast Asia are really big clients for U.S. exports. But when this situation with the euro going down, the dollar strengthening, is that situation going to change in the future?
I think that really reflects a misunderstanding about how the U.S. companies service foreign demand. It's not by exporting, even though the U.S. last year was the world's third largest exporter behind China and Germany. The way that U.S. companies service foreign demand is primarily building locally, selling locally. So it's not just that the U.S. exports a lot to Asia, because a lot of those exports are semi-finished goods, parts that get assembled in Asia and they get exported primarily to Europe. For example, the Europeans are China's biggest export destination. And so the point, I think, is that the decline in the euro might help boost exports. The strength of the dollar might not really hurt U.S. foreign sales, even if it might squeeze exports on the margins. In general, the best thing for U.S. exports, strong world demand. The reason that the U.S. might not be able to export as much to Europe might not be so much because of the dollar. For example, Windows. Is there really an alternative in Europe to Windows 7 or to iPads? And so instead, it seems to me that the key is demand. And what Europe is doing, rightly or wrongly, is they're tightening fiscal policy. This is going to weaken domestic demand, and so they're not going to buy any goods, even locally produced goods. We already saw countries like Greece, Finland, still contracting. Still economic contraction. They can't buy goods. That's the key, I think.
So also, let's see how traders are watching right now the situation going on in Europe. Do they think that is going through the right way? Do they think that Greece is going to default? What's going to happen there?
Well, I don't think the traders are really telling you that they have an opinion one way or the other on the default of Greece or any other European Union member. I think what the traders are telling you is that the long-term investor has taken a step back from the table, and they're waiting to see for some real stability. And I don't think they view, the indexes are telling us that we don't see real stability in the region. You had mentioned the controlled decline in the euro. But for the equity trader, there's still a view, certainly within the momentum group anyway, because we have diminished liquidity as the long-term investor backs away, the momentum traders are able to manipulate the market on any data point, whether it's positive or negative, that comes out. And because of the lack of liquidity, if you see a bad headline that pops out, let's just say in the European Union, for example, in debt contagion or the debt-related issue, they'll be able to move the market accordingly. And what you see is a game of leapfrog, so to speak, where people are all trying to jump through the same exit. Or if they're trying to buy, if it's positive data point, they're all going to go through the same door to get in. And what you're seeing is the beta in the indexes reflect just that momentum play and not the long-term view.
And what about China, this situation? Because it seems that the U.S. government has been seeking Beijing to strengthen its currency, but then this never happens. It's in U.S. benefit for China to strengthen that currency or not?
Well, I'd say a couple of things. One I'd say is because Europe is China's biggest export market, and the euro has fallen roughly 18%, that means that the Chinese currency, in effect, has appreciated 18% against the euro. So the U.S. has advocated a stronger Chinese currency, but instead we got a weaker euro, tantamount to the same thing. But more importantly, I think that we're going to see in the next short period, focus not so much on the currency, because China, as you say, probably is not going to budge on its currency. But what's happening is Chinese companies are raising wages, and that's really the key here. China doesn't compete simply on a cheap currency. Even if the senator from New York is correct and the Chinese currency is 30 to 40% undervalued, even if they would get that kind of appreciation, not enough. That the key is that Chinese wages, manufacturing wages, are roughly 3% of what they are in the United States. So even if they double the value of the currency, so now the wages are from 1/33 of ours to 3% of ours, so now it's 6% of ours. China has a big competitive advantage in wages, and the promising development over the past week or so is Chinese workers are striking, like a Honda factory, a Japanese factory in China. The company that makes a lot of Apple goods and Dell goods are talking about doubling workers' wages in the next couple of months.
Wow.
That is a positive thing that helps even up the tails, not completely yet, but it's a step in the right direction. Keeps our eyes, forget about the currency markets as a source of competition, wage developments, wage differentials is really the key.
And also, Jason, imagine that I'm a main investor right now, and I give you 3 situations of what I could do. Can I jump in equities and invest in equities? If I'm invested in equities, should I go out, or should I stay in the market?
Well, it depends how readily you need the cash, or if you need access to the money and how liquid you are. But I'm a very long-term bull. I didn't expect a 3-pronged, somewhat financial war that we're looking at right now between euro debt and 2 geopolitical situations that are going on right now. Well, one with North and South Korea, and the issue in the Middle East, which is, we got several fronts. All 3 of those things in the U.S. equity market have muted what was just a great earnings period and guidance going forward. A lot of that got lost in the mix, but that's how the game works. If I had a long-term horizon, I would probably put 1/3 of my cash to work. And you know what? If the market takes off and you've only put 1/3 of your money to work, you're in the game. If it goes the other way, you have a way to average down. I still think things look really great. We're near bottom here technically, but we are testing a certain level with the S&P. I'd like to see it hold that level. And I would say put 1/3 to work on the way up. If we have a 15% appreciation on the way up or 10% appreciation on the way up, and take the 2/3 and leave it there. But you need the ammo to be dry on the way down.
Yeah. And under your perspective, which are the safer sectors right now? Where would you put that money?
Well, I am a firm believer in the financial sector, and I think if the overall market's going to lift, the financial markets...
Even with the financial reform going on and everything?
Because the people that work in the financial sector, as much as we like to make fun of them, and I'm one of those people, they're usually pretty smart, and they can figure out how to... If they change the rules of the game, they'll figure out how to play the game. They've done it time and time before, and they'll do it again. I also like the technology sector, and the sector's really been beaten up because there's a lot of profit-taking going on in that sector right now. But it's one of the few sectors that we have where it's the only sector, actually, where you get to reinvent the wheel. And very rarely do you get the opportunity to invest in